The $20.7 trillion commercial real estate market is in big trouble. A few weeks ago, Treasury Secretary Janet Yellen publicly stated,
I do think that there will be issues with respect to commercial real estate.
And famed entrepreneur Elon Musk tweeted, commercial real estate is melting down fast. Home values are next. Yellen and Musk don't agree on much when it comes to economics, and so it is important to pay attention when they are both sounding the alarm on the same issue. The first thing to understand is that demand for large commercial real estate buildings, such as office towers in big cities, has been rapidly declining as work-from-home trends turn into the next market standard. According to a recent National Bureau of Economic Research working paper, attendance in the 10 largest business districts in the US is still 50% below its pre-COVID level, and white-collar employees spend an estimated 28% of their workdays at home. That's a wild stat. The percentage of full days working from home was only 5% before the pandemic, and so the recent trend has caused a lot more than a 5x increase in the baseline number. Now, the national average vacancy rate for these buildings is 19%. Los Angeles is 26%, New York City 23%, and even Miami, which many people agree has been the big winner of the pandemic migration trend, is sitting at a 16% vacancy rate. These are staggering numbers. And as demand has dropped, equity and debt investors have been trying to identify the current value of these properties. We saw a building in San Francisco, which is owned by Mitsubishi and was previously valued at $300 million, put on the market for an 80% discount. Where else are you going to find 80% discounts on assets, especially in the real estate market? This was followed by a report just last week that 2 different office buildings in Midtown Manhattan sold for almost 50% less than asking price. It's like having something that's worth $1 sell for less than 50 cents. You just don't see it very often. As you can see in the data that's been provided by the IMF, commercial real estate prices rarely go down. So it can quickly become catastrophic if the market does not correct and stabilize. As we see, the only time that commercial real estate prices have really dropped is during the global financial crisis. Yes, they go up and they go down, but they never really break the baseline. But as you can see, we just crossed over and now are headed negative. The good news is that the blended delinquency rate on all commercial real estate debt is still relatively low compared to the historical trend. Now, it is true that the overall US CMBS delinquency rate jumped to 3.62%, which is up 53 basis points for the month of May. But the all-time high on that exact same metric was over 10%, which was registered in July 2012, and the COVID-19 high was also just over 10% in June of 2020. So the record is over 10%, and we're sitting below 4%, which should give you some comfort. But the problem in the debt market is not what has happened already. It's in the tsunami of debt refinancing that will need to happen over the second half of 2023. Megan Henley recently wrote an article where she stated, quote, about $1.5 trillion in commercial mortgage debt is due by the end of 2025, but steeper borrowing costs, coupled with tighter credit conditions and a decline in property values brought on by remote work, have increased the risk of default. Fitch Ratings already estimated that 35%, or $5.8 billion of pooled securities commercial mortgages coming due between April and December 2023 will not be able to be refinanced. End quote. Now, this is problematic because the interest rates have more than doubled in the last 2 years. As you can see right here, the interest rate on a 30-year fixed mortgage was around 3%. Now it is over 6.5%. That spells trouble. To make matters even more complicated, 67% of commercial real estate loans are issued by small and mid-sized banks. These are the same banks that have felt the brunt of the recent banking crisis, which is induced by the Fed's 500 basis point hike in interest rates, which is the fastest pace in history. The Fed said that they were going to keep interest rates low, and instead they jacked them up faster than we had ever seen before. These small and mid-sized banks, they're not really responsible for that much debt in the total economy. That usually resides with the big banks. The bigger the bank, the bigger the share of debt, usually. But the commercial real estate market is different. 67% of all commercial real estate debt is with these small and mid-sized banks. Now, although most of these banks did not fall victim to the market in the way that Silicon Valley Bank, Signature, and Silvergate did, there's still immense pressure on these institutions in the current environment. Then you add in the idea of the Fed conducting further rate hikes later this year, which the Fed recently said they were going to do, and the doomsday scenario becomes clearer. John Maynard Keynes, who's a famous economist, observed, when you owe your banker $1,000, you're at his mercy. But when you owe him $1 million, the position is reversed. Now, there's a second order effect that we need to call out. Most people haven't even gone to this yet. They're not talking about it. but this one will scare the hell out of you. There's a very real chance that municipal government finances will take a hit as well. Dror Polig recently wrote for The Atlantic, quote, "Municipal governments have even more to worry about. Property taxes underpin city budgets. In New York City, such taxes generate approximately 40% of revenue. Commercial property, which is mostly office, contributes about 40% of these taxes. So 16% of the city's total tax revenue comes from commercial property." Mind blowing. NYU professor Arpit Gupta and others estimate a 6.5% fiscal hole in the city's budget due to declining office and retail valuations. Such a hole would need to be plugged by raising tax rates or cutting government spending. End quote. Now, the potential solutions to this problem are few and far between. One idea is private equity investors will step in to gobble up commercial real estate assets. This is probably true, but it will only happen at a very depressed price from current levels. There is significant economic pain between where we are today and where prices would have to trade in order to get transaction volume growing again. There is just a disconnect between buyers and sellers at the moment. Another idea is that these commercial buildings could be converted into residential buildings. Theoretically, this makes sense. Yet there are a number of complexities that developers will have to navigate to make it a reality. The most obvious one is zoning and permitting. My guess is that it'll take a long time or be expensive for developers to navigate that one. But there's also more technical issues like plumbing infrastructure in the buildings having a low probability of being adapted to the residential use case. So there would be significant construction needed to retrofit these assets. Just think about a single floor in an office building. It only has 1 or 2 bathrooms usually. But if all of a sudden you convert all that space into different units, you need 1 or 2 bathrooms for every unit. That means there's a lot of work and a lot of expenses. There's also a number of people, though, who believe the commercial real estate crisis could be averted. Marco Santarelli uses 3 examples of risk mitigators in the market. He says, number 1, there's diversification of commercial real estate. While the office sector is facing significant challenges, other segments of commercial real estate, like industrial, retail, and hotels, they're performing relatively well. The diversity of assets in the commercial real estate market provides a buffer against potential risks, as the struggles in one segment can be offset by the strength of others. The second thing Marco points out is that the manageable refinancing is available. Despite the refinancing cliff, a considerable portion of commercial real estate debt appears capable of being refinanced without major issues. Banks have maintained strict lending standards, and most debt in the market generates sufficient income to meet these standards. This indicates a certain level of stability and preparedness in the industry. And the third point that Marco makes is that there's strong credit performance so far. The banks have reported excellent credit performance in commercial real estate lending with low delinquency rates and minimal losses. This suggests that lenders have been cautious in their underwriting practices and have managed risk effectively. The overall health of the commercial real estate market's credit performance indicates a level of resilience in the face of potential challenges. Now, I want to make something very clear, that it is unclear how bad the commercial real estate market will get. There's significant risk here, not only for the investors, but also local governments. And I anticipate that this topic will gain coverage throughout the end of the year. It'll become more popular, and there will even be fear-mongering by the mainstream media. The Federal Reserve and the Treasury are supposedly watching it closely. Various banks will have to navigate the obstacles ahead or risk going under. And none of this analysis has even touched on the knock-on effect of the commercial real estate stress to residential real estate. If we enter a recession in the second half of 2023, it may be the most telegraphed recession of all time. That doesn't mean that the economic pain and destruction will be avoided, though. I don't know what's going to happen, and neither does anyone else. But there's pain brewing in the commercial real estate market, and it's time that you start paying attention.